Well, Brandon, I think that most of us would agree that this year, 2020, is one that we'll be happy to see go away. What's interesting is that the year started out with one of the biggest and fastest declines that I've seen in my career. The decline came out of nowhere during a stable and somewhat boring market. Following the drop, most markets then advanced back to the old highs in the face of some of the worst news imaginable. It now appears that we may be entering one of those periods that can rob many Americans of their future financial independence. Markets can be cruel. They can give and give some more and then take it away. Making money means nothing if you can't keep it. The periods that are responsible for wiping out years of savings and growth have one thing in common. They occur when market indexes and portfolios have a high concentration in an asset class that has experienced a major advance. In the current case, we're talking about the technology sector.
Today, the major market indexes, like the S&P 500, have the highest concentration of risk since the beginning of 2000 and also 2008. Make no doubt about it, we are in an extremely high-risk environment. Over the past 10 years, declines have been sharp and fast, but have rebounded quickly. These moves are called trading anomalies and are not to be confused with a true bear market. The trading anomaly we experienced back in March saw most major stock market indexes fall by about 30% or more in just about 20 trading days. Most of these indexes rebounded back over just a few months. Trading anomalies are like the foreshocks that occur prior to a major earthquake. In the case of markets, anomalies tend to get bigger and more volatile prior to a true bear market. These shocks are like the little boy who keeps crying out wolf. Investors eventually get numb to the anomalies and expect the future to continue to look like the past.
Bear market environments will behave almost opposite of what was experienced over our past memory. For example, the 8 or 10-year bullish period of the late 1990s behaved almost opposite of the 8 to 10 years that followed from 2000 to 2008. Then over the last 10 years, the equity markets changed its personality again to the opposite, and we saw a generally low volatile extended advance. Bear markets begin at a new market peak when most investors would least expect. The early declines look similar to the previous anomaly, but the outcome will be the opposite. There will be no major rebound to new highs. Instead, there will be a series of a stair-step pattern with lower lows and lower highs that pick up downward momentum as the bear unfolds. Another early indicator of a coming bear market is the presence of a bubble that is forming in a large sector of the market, like the technology bubble of today. Okay, so Brandon, what we're going to do is start with kind of discussing the Standard & Poor's 500 index. And as many of you know, the Standard & Poor's 500 index is what's called a capitalization weighted index. So capitalization, if you take Apple, for example, you take the total number of shares outstanding times the price per share, and that tells you how big that company is. And actually, Apple makes up about 7% of the Standard & Poor's 500 right now. Now, there are 10 sectors that make up the Standard & Poor's 500. In a perfect world, we would like to see kind of a similar amount of cap weighting among each of those 10 sectors. If that were the case, then the Standard & Poor's would be a reasonably good, diversified portfolio. But that's not really what's occurred over the last few years.
Yeah, and as we've talked about in recent updates, technology, or one sector out of those 10, makes up 40% of the S&P 500's cap weighting. The top 5 stocks in the market, which are Google, Amazon, Facebook, Microsoft, and Apple, make up 23%. So 5 stocks make up a quarter of the market's sort of overall weighting.
Put that in perspective compared to some of the other 10 sectors.
So here's a chart of the S&P 500 sector weightings. And so if we're looking at this, market portfolio, you can see that it's really not diversified and it's way out of balance, as Tom mentioned. And that is because of technology. That dark blue segment there, which is technology-related stocks, makes up over 40% of the market's portfolio. Or in other words, 40% of the market's movements can be attributed to technology. That's larger than industrial, staples, discretionary, utilities, materials, real estate, and energy combined. So one sector has, the same or more impact than 7 other sectors combined. And that's similar to what we saw back in 1999, kind of heading into the 2000 technology bubble before technology crashed. Back then, again, technology made up 40% of the overall market's movements. So the question then becomes, how does this happen? And why is this a problem?
So the question is, how does the S&P 500 get so far out of balance? Well, there's one of two things that occur. Either number one, a sector like technology just takes off and leaves everything else behind and becomes a major component in the index, or the other sectors decline or go nowhere and become smaller and smaller sectors of the market. And we've really seen a combination of those two.
Yeah, so let's go to this chart here. So this chart shows the top 10 technology stocks compared to the other 490 stocks in the market. And you can see that this year, given all the crazy things that have happened, at one point in September, these 10 technology stocks would have actually been up 80%. So that's partially how technology became such a large segment of the market, is because these stocks rose dramatically. On the other hand, the other 490 stocks have really gone nowhere. In fact, at the time this chart was made last week, those stocks would have been down 8% year to date.
Yeah, and I think realistically, when we look at everything that's happened this year, and beginning with that sharp decline that we saw in February and March, for the rest of the market to be down, single digit is probably not that bad. That'd probably be better than what most people would expect. But what we're really concerned about is that 80% move that we saw in technology, which is kind of an unprecedented move, and it is a classic bubble. Bubbles in that last leg, when you get into that last year to 2 years, that's where most of the move comes. And that's exactly what's occurring. And if and when that bubble pops, it's going to have not only a big impact on technology, but it's going to have an impact on the major indexes, which most portfolio managers use as a guide to weight their portfolios.
And just to show a quick few charts, this is exactly what we saw happen in 2000. This year is a 10-year chart of the NASDAQ index, which is basically a technology-related stock index. And this is the 10 years heading into the 2000 sort of technology bubble and technology crash. And you can see here in that 10-year period from 1991 to 2000, you saw 900% return. Again, in the last 10 years, so from about 2009 through basically today, we've seen plus 800% return in the NASDAQ 100 index. So basically 2 parabolic advances over different time frames. Here is the 5 months heading into the peak in 2000. That was plus 70% on the NASDAQ. And then again, here is 5 months, basically from April of 2020 to September of 2020. Again, you've seen a huge parabolic run, plus 60% in technology-related stocks. And as Tom mentioned, we knew how that ended. Technology got to be a huge percentage of the S&P 500. And not only did technology crash and fall by 80% in 2000, we actually saw it drag the entire market down with it. This is a chart of the S&P 500. And over the course of about 3 years, it lost 50%, because it was so technology heavy and because technology was, had become parabolic, become out of whack, and had its bubble burst.
Brandon and I have a few closing remarks. First of all, we are portfolio managers. The purpose of portfolio management is to produce the highest returns over the long run. And in the case of individuals, the goal is to produce the highest returns while maintaining financial independence.
Yeah, and the practice of buying and holding a market index like the S&P 500 or the Nasdaq 100 leaves investors vulnerable to the variable changes in market climates. In particular, we're talking about the storms called high volatility and bear markets. In today's case, we're seeing a formation of a bubble, which typically becomes the trigger point for a classic bear market.
Yes. So here at Canterbury, we spent years of testing and development to build an adaptive portfolio management process to actually manage and benefit from the kind of environment that we'll be experiencing.
Our portfolio thermostat process made the necessary adjustments to stabilize the portfolio back in April following an unprecedented and really unexpected market event. The decline that we saw in February and in March was larger than what anyone would have thought, but we knew from our studies that markets would experience a 50% rebound from the previous peak. And that's exactly what happened. We followed our process at that point to stabilize the portfolio.
Yeah. And from that point through now, the market's performance has been really distorted by the large market weighting and the parabolic nature of this advance in the technology sector. The portfolio thermostat has moved up in an orderly fashion while maintaining extremely low volatility. The markets have experienced several pullbacks over the last 6 months, and it's had a number of outlier days, but the portfolios remain stable, and the largest peak to trough decline that we've experienced has been a little bit more than 4%.
And we don't know when the technology bubble will pop, but as we showed in those charts, the increasing parabolic nature of technology, along with the sharp declines that we've seen over in the market recently, are starting to give the signal that it's getting closer to an end.
So as the technology bubble begins to unwind, the thermostat will continue to adapt its holdings with the purpose of benefiting from the market's decline and the coming increased volatility.